Hey, what's up? It's episode 46, Pain Points of Wealth, and it was a crazy week on the Street of Dreams. We had a mini sell-off or a mini correction on Monday as markets looked like they were ready to crash. But by Tuesday, markets were marching higher again as earnings season has got off to an awesome start. Companies' earnings are blowing away estimates. Economic data keeps coming in stronger and stronger. Is the party going to continue? What's going to happen between now and the end of the year? We're going to give you our viewpoint on exactly what's going on right now. And on the tipping point today, we're going to talk about financial catastrophes. What could derail your entire financial plan? What do you need to be aware of to avoid any sort of disasters in your financial life? We're going to give you our blueprint for that. We got a great show for you today. Let's hop to it. Hit the music.
Welcome to the Pain Points of Wealth, the podcast that addresses the pain points that come with creating, growing, and sustaining your wealth, giving you a multi-generational perspective from three Pains in a pod. Bob Payne, the boomer, Chris Payne, the millennial, and Ryan Payne, the generation somewhere in between.
I don't know what you're talking about. The last time we recorded this podcast last week, the market was at all-time record high. Here we are a week later, recording the podcast. Market's at an all-time record high. What correction are you talking about?
It happened so quick, Bob, and you can almost feel it in the air, right? And we saw some sectors sell off like 5%. Like energy was down big on Monday, and you just thought, okay, here it comes. We're going to get that proverbial market correction where markets are going to sell off between 10 and 15%. Gird your loins, as someone we used to know used to say, and it just didn't happen. The next day, it's like all of a sudden the market's turned and they haven't looked back.
Well, here, guys, here's a great real-world example of this. I talked to one of my clients on Thursday, and they were in absolute panic because they said that, one, they never, ever check their account. They never look at their account, except it seems like when it's gone down. I don't know if you guys experience that with your clients, but anyway, I digress. But they said to me, I checked my account on Monday. What's going on? How come the market's crashed? We're losing all of our money. Is this the end? And I said, well, did you log in and look at your account today? And they said, no. I said, well, look at it today and tell me what you see. And they went and looked and, oh, everything's back to normal. Everything's okay. I said, okay. I said, listen, one cold day doesn't make a winter.
Chris, as I love about working with clients, I mean, one day and they want to know if it's over. I remember 1994, we had the market go down every month for a year. We had interest rates go up, stock market go down 12 months in a row, 12 consecutive months of their accounts going down, statements dropping month after month. Best line I ever heard in my life. Hey, Bob, I never look at my statements. However, I just happened to take a peek and it appears we are circling the drain. Think of that visual.
Well, and that's the other thing to think about right now. It's like the market has a small correction, the euphemism that I love, on Monday. People start to panic and you start thinking investors are getting spoiled here. It's like you're supposed to have markets sell off once in a while. It's normal, but we've had a really abnormal market because we've had very little volatility. Markets essentially have been going straight up here, which makes me think, man, oh man, we get a real correction. It's not going to be pretty.
Well, real corrections are the normal part of markets, right? This is the first drop we've had since October. Think about that, guys. We haven't had a 5% correction since October. This is the biggest drop in 9 months. So that's a little unusual. And now, guys, you know why we had a drop on Monday, right? What were the headlines, Chris, on Tuesday?
Well, I think the excuse, and I use that word excuse very deliberately, is because of this Delta variant and how it's having a worse impact than we could ever anticipated.
That was a headline in every paper, whether the Wall Street Journal, Barron's, the Nightly News. It was the Delta variant. Now, of course, they didn't mention it on Wednesday or Thursday or Friday when the market went up. Is it possible that we stopped the spread of the Delta variant in 24 hours?
I don't think so. If anything, I think it's been spreading the rest of the week, which also shows you how the news likes to fit, into some sort of narrative of what's going on with the market. It's the market drives the news. It's not the other way around. But what I think is interesting right now is the market really isn't going down very much, right? You do get this proverbial sell-off. I'm using that word a lot today. And you're just seeing the buyers come in. And I know we know this anecdotally. There's just so much cash out there on the sidelines. How many people have you spoken to this year that sold out of the market last year, been waiting to get back in because they're hoping they're going to get a big market crash at some point, As you like to say, Bob, bull markets just don't let you in. So every dip here is being bought. And I argue that could go on for a long, long time.
It really could, Ryan. That really goes back to what we had talked about last week when we talked about the TINA concept. There is no alternative. And to put that in perspective, this past week, the 10-year Treasury dropped by 1.2% a year. So if you think about it, you've got all this cash. You're getting less than 1% sitting in cash. You're getting 1.2% on your money market. And if you think about inflation over time, which is going to be above 1.2%, I think in the average since World War II is 3%. If they put it in perspective, for every $100 you invest, it's going to be worth $90 of purchasing power in 10 years. So basically, you're guaranteeing yourself to lose money.
No, that's exactly right. It's the proverbial TINA trade. There is no alternative. And that's like the question is, where's money going to go? Stocks are becoming more and more profitable, or companies becoming more profitable. Economic data is going to continue to get better because we know the world isn't fully open yet. That's going to continue to go up. So I think your bigger risk here, and we've talked about this a lot because a lot of investors right now have gotten very nervous, is, oh my God, we're going to get a huge market crash. Your bigger risk here is we could get a huge market melt up and you're sitting in cash and you miss it.
Yeah, absolutely right, Ryan. I always say the reason we have unexpected moves in the financial markets is because simply they're unexpected. But what's been expected is in this big booming recovery are big booming earnings, and the earnings have been off the charts. We're only the second week in the earnings season, and we're having companies one after another, 90% of companies beating on the top line and the bottom line. That's way above the average of 70%. This is what's been expected. The market's reacting as expected, and as a result, market's going higher.
Yeah, because the thing to remember too here is it's like what isn't expected, Bob, to your point, which is another Bobism. It's why do unexpected moves happen in the market? Because they're unexpected, is the fact that things are even better than what has been anticipated. And I think that's what you have to think about here is if companies keep beating the way they've been beating the estimated view on Wall Street, well, that's going to be another catalyst to push prices higher. And that's been the trend. Chris told me the trend's your friend. I don't know if that's true or not.
I can tell you absolutely 100%. I never said that. Because just when you think the trend is your friend, it turns around and stabs you in the back.
Hey, it'd be a lot cooler if you did, Chris. You did say that.
So meanwhile, guys, we have the stock market at all-time record high. We have bond yields dropping, which is kind of counterintuitive because inflation's everywhere. We just had the producer price index jump 7.3% last week. You had inflation, the CPI, come into 5.4%. Now, don't you love it? The government, they rule out that, that unimportant part of inflation, food and energy, it doesn't count. They exclude that. Well, all I know is it cost me a fortune to gas up my car. You guys were just down here for the family barbecue. It cost me a fortune just for hamburgers and hot dogs. Inflation's going through the roof. Why are interest rates going down?
Well, Ryan, and I don't ever really have to experience that inflation because Dad's always paying for stuff, which I don't have a problem with.
And he grills everything. Oh my God, it's amazing. Everyone should spend a weekend at Casa de Bob down in Ocean City, New Jersey. Just saying.
That's right. We don't call him Bob Propane I think for nothing.
Exactly. The master griller. Bob's the master planner, a master griller, and you can't put one in front of the other. But I think, the other narrative right now is everything is at a peak. And that's true, right? If you compare this year to last year, you're comparing last year this time. Remember, it was summertime. The economy was doing terrible. Everything was locked down, and now everything's open again. So, of course, the profits are going to come in way better than expected, and they're not going to come in this awesome ever again in this cycle, right? You're going to see profits go up, but it's going to be at a slower pace. So the question is, if everything's at a peak right now, are stocks at a peak too?
I'll tell you guys, it really isn't all about peak earnings. It's not about peak productivity. Productivity's going up. The Federal Reserve is printing more money. There's lots of liquidity. They're still buying bonds. Lots of other companies are opening up now. We still have 9.3 million jobs that are unfulfilled. So things can get a lot better, or they get a lot worse. But the stock market's telling you the way to think because the market doesn't care about the way things are. They care about whether things are getting better or things are getting worse. And I'm telling you guys, the numbers I'm seeing from earnings and projections for next year, things are getting better, way, way better.
Yeah, that's absolutely true, Dad. Things definitely are getting better. And, in some instances, when it comes to investing, some places are better than others when it comes to putting your money back in the market. And right now, just looking overseas, like in the emerging markets, for example, it's still a relatively cheap place to add money. And if you look at like the S&P 500 right now, it's trading at 22 times earnings, right? So it's pretty expensive. Whereas like if you look at like the emerging markets right now overseas, that's really starting to benefit from the opening up globally. It's trading at like 16 times earnings. So, even with the market being as high as it is right now, there's still a lot of value to be had in other places. And not to mention, they pay my favorite, dividends. And as I always say, you get a better outcome with income.
Chris, absolutely agree. And I talk about this all the time about having a conventional portfolio versus an unconventional portfolio. To really succeed as an investor, you've got to be a contrarian, and that takes a lot of courage. It's a lot easier to lose money when in a conventional way because you're like, hey, I lost money because everybody else lost money, and I'm making money because everybody else is making money. To really be a great investor, you got to be a contrarian, and it's really hard to sell what's popular and what's up to invest what's out of favor. But that's where the true rubber hits the road. When you have a non-conventional portfolio where you're able to take money off the table when things are overvalued and invest in things that are clearly undervalued. It's unconventional. It takes courage. Not a lot of people can do it.
All right, guys. So to wrap things up here, look, we saw a tiny mini market correction on Monday. It wasn't a market crash. If you're sitting in cash right now, you're wondering, waiting. It doesn't pay to wait. The risk here is earnings are going to come in better. Economy is going to be stronger. There's so much money sitting in cash. As Bob likes to say, you got to be in it to win it. Hey, I hope you're enjoying episode 46, Pain Points of Wealth. If you're enjoying our content, you really like it, go ahead and give us that 5-star rating if you're listening to this on iTunes. If you're watching this on YouTube, don't be shy. Click that like button, subscribe to our channel. You can click that little notification bell so you can be updated on every new episode every single week. And if you have a friend, family member that could enjoy our content as well, feel free, share our content, share the love. All right, gentlemen, it's the tipping point where we pinpoint the pain point having the biggest impact on your wealth right now. So Bob and Chris, in our collective 75 years of advising individuals on their wealth, what we've learned is disasters in the financial world happen. And depending on how severe that issue is, many circumstances can be catastrophic and actually derail your entire financial plan. So I thought we could talk about some of the more catastrophic events that could happen and how to avoid them at all costs.
Right, sounds pretty simple. Just put everything into a 360 financial portal, right? Which we'll do. But I got to tell you, most of you are procrastinators. And what do you want to procrastinate the most when it comes to, anything in your life? How about your finances? It's boring. It's not interesting. We love it, but we're boring people. That's why people hire us. We love to do this, but it takes a lot of time and effort. And that's why you need somebody to push you a little bit.
Well, the truth is it's not that hard. It just seems that hard and daunting. And I think there's a lot of reasons why a lot of us just we procrastinate on dealing with it because it's like, finances. I got to figure out what my statements are. But when I love doing this and I love taking people through this process because you found what I call found money. You forget about different accounts that you had, or maybe you have a savings account and a thrift that you forgot about from years ago, or old 401ks. And when you start to paint that picture, and this is like the beginning of all financial planning, is just getting financially organized. And the reality of it is to put all this stuff into the computer, put it into one portal, it's not that hard.
And that's the beauty of it. You go through it every year. And to your point, Rye, you find things that you didn't realize existed. Like actually think on your portal, Rye, you have the change that's actually in your couch right now. So, it just comes down to having an account of every penny, having an account of where all your legal documents are, tax returns, the whole 9 yards.
Well, my strategy is when someone sits on my couch, I literally start to bounce them up and down so all the change falls into the couch, and I put that in my piggy bank, and that's essentially how I'm saving all this money.
Another masterpiece financial plan by Ryan Payne.
Bob, Chris, and I now have a collective 75 years helping individuals just like you with their planning and investing. This is literally what we do every single day. Everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially speaking at any stage of your journey. But if you want a more hands-on approach and you have over $750,000 saved for your financial plan, well, you can apply for a free complimentary financial review. Simply go to www.payncm.com/financial plan or click on the link below. We're going to put together a full audit of your investments, the fees you're paying. a tax optimization strategy, and literally put together a full expense and income plan to ensure you're on the right path to achieving financial independence. Simply go to www.paincm.com/financial plan to see if you qualify for a complimentary or free financial review. Hey, hope you're enjoying episode 46, Pain Points of Wealth. If you like our content, love our content, give us 5 stars on iTunes, show us the love, put a like, put a comment in, subscribe to our channel. If it's on YouTube, you can click that little notification bell so you can be updated every week as our new podcast comes out. Give us the love. We're doubling our subscription base. We'd love to have you part of the party. Like our content, subscribe. All right, gentlemen, it's the hidden facts of finance, random financial facts that may surprise you or even shock you. And that's another interesting thing besides my birth in the 70s is everyone talked about the 70s being a horrible time to be an investor, but when you factor in dividends, it wasn't that bad. Chris, the federal deficit is now 1.3 times the size of the GDP here in the U.S. That's the highest it's been since the end of World War II. Plus, the U.S. has about $28.5 trillion worth of accumulated debt. If rates rise by 1 percentage point, that's another $285 billion of interest expense for the U.S. government annually. That's scary.
Man, I'll tell you what, they say that compounding is the 8th wonder of the world, except when it goes against you and it's not in your favor. Imagine $285 billion over the next 20 years. That's a lot.
Sounds like we need to start paying that deficit down, not increasing it, just saying. It could be dead wrong. And, Snap came out with great earnings this past week, and they're trading at 350 times forward earnings. A lot of these stocks, multiples are getting crazy. You got to be really careful how you're investing your money right now. Chris, domestic production of semiconductors has been declining for decades. Today, only 12% of semiconductors are manufactured here in the good old USA. Taiwan Semiconductors manufacturing company alone makes up 56% of market share in certain global markets for advanced technologies.
Well, I'll tell you what, guys, this is not the only thing that gets manufactured overseas, and that's why it's so important to not just be invested in the U.S., but also so much more important to be invested overseas, especially in those emerging markets.
Invest in the global markets. You heard it here first. All right, gentlemen, another great show. As always, stay loose and keep an open mind.
Thanks for listening to the Pain Points of Wealth. Hopefully you found the ideas discussed in this episode valuable and useful for your own financial journey. You can find out more about Bob, Brian, and Chris's firm, Pain Capital Management, at bebullish.com or through the contact information found in the description of this episode in your podcast player or app. Join us next week for another episode of The Pain Points of Wealth, brought to you by Pain Capital Management. Information provided on today's show is provided for informational purposes only and does not constitute investment, tax, or legal advice. Information is obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed.